It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, smartest guy in the room, the governor of the great state of Texas, Mr. Michael Becker. Michael, how are you?
Paul, doing pretty good. We're in the beginning of the second quarter 2021, and it's pretty bullish here in Texas multifamily. Everything seems to be going pretty good. How about you guys? What's going on in the lending world?
Coming into the second quarter 2021, we're very, very optimistic. We had a great quarter for the first quarter of 2021, first 3 months. Hundreds of millions of dollars worth of transactions that we closed. And so we're hoping that momentum keeps going. We think it will. Interest rates have ticked up a little bit, and so we're a little bit concerned on that. But being an old timer, I can remember when I got into the business, interest rates were at 14, 15% on home loans. Prime rate was at 21%. And when I start telling people that interest rates may go from 3.25 up to 3.5, 3.60, they say, "Oh my God, interest rates are killing me." And I'm going, "Are you kidding me? This is like free money. This is nothing. Take the 3.5, 3.7, and just keep going, baby. These are the good times that you will remember." So so it's going well. So don't forget, go back on to the Old Capital Podcast website, get the 17, 18-page white paper report that Michael and I wrote. We just updated it for 2021. We talk a little bit about the COVID reserves that are required right now. We think those are eventually going to be going away since the vaccination is becoming more and more popular throughout the United States. We think in some period of time, I think Fannie and Freddie will start to ease off a little bit on that one. And then when you also have a chance on the Old Capital Podcast, if you are in the Dallas-Fort Worth area, we are starting on May the 4th. As I say, May the 4th be with you. We're having the Old Capital Speaker Series live in Grapevine Convention Center. We'll have 200 or 300 people there, given the ability to shake people's hands. We're probably going to still require masks to be worn, but we're going to get people for a live event on May the 4th, Grapevine Convention Center. You're going to need RSVP to that event, and we'd like to see you there. And I think Mr. Michael Becker, is going to be speaking with a number of the top producing apartment brokers in Dallas, and I think maybe in San Antonio. Austin may be coming up to visit with us. And then we're just going to be talking about the state of the market, kind of understanding a little bit more. It's great to listen to Michael and listen to his breadth of knowledge, but it's super important to meet other investors that are like-minded to kind of give an idea of is this a great time to get into multifamily investing. So hopefully Michael Becker will be there. Michael, do I have your confirmation yet?
Yeah, I think so. That should work. So looking forward to it. I guess we got to figure out who we're going to talk to. So let's get a plan together.
Yeah, we have that all put down, so we know exactly who's going to be there. Some of the top producers that you want to talk about. So we're excited about that. Michael, how is business these days? I mean, I always try to take your temperature, so to speak. Michael, as you know, has bought over 10,000 apartment units. So we love to listen to some of the stories that Michael tells, but we also want just to kind of take the temperature of what you're seeing out there.
Yeah, I think it's a pretty good first quarter. We bought 2 deals. We syndicated, so we raised capital, bought a deal, two suburban Dallas-Fort Worth deals, and then we just got into escrow on a pretty deal down in Austin, straight from the developer. We have a 1031 partner we're buying that with, and we're actively trying to put together some more deals to go syndicate. And it's tough. I mean, it's expensive. There's a lot of competition. We've historically focused on Dallas and Austin, and both markets are white hot. I think I read an article on the single family side, Paul. There's like 0.4 months of supply in Austin, and like 1 month or maybe 0.9 months of supply in Dallas-Fort Worth for the single family homes for sale, and 6 months is kind of considered a normal market. So it's far from normal. It's really next to impossible to buy a single family home. And then I think that's starting to translate into, higher and higher occupancies in the multifamily space. I mean, we're a little bit over 95%. I think it's like 95.2 or 95.3 physical occupancy across the portfolio. That's the highest I can remember. And then we're at the best part of the leasing season as we record this too. So demand's extremely high, and rental rates, after kind of sitting on our hands for 9 months at the end of 2020, the first quarter, we probably saw somewhere around 5% rent growth in our portfolio, Paul, on the leases that we signed in the first quarter. So my crystal ball is probably 5-ish% in Dallas Fort Worth, and 6, maybe a little bit above in Austin is kind of my prediction. It's basically virtually no inventory on the market in Austin, and the stuff that's on the market in Dallas, from a guy that's been around the block at the time or two like I have, it seems expensive relative to historical norms, I mean, certainly compared to historical norms. But rents are going up and there's a ton of money. So I'm glad we own a bunch of units, because it's becoming, expensive to buy. But I mean, the fundamentals, I think, are still in pretty good shape. As you mentioned, and interest rates have ticked up a touch. That's really on the long end of the curve. That's on the 10-year. And so you take your 10-year fixed rate mortgages. Those are the ones that have kind of ticked up a little bit. But as we talked about previously, and the debt market on the bridge side is robust and active, and everyone's going kind of pivoting to that right now. And so that's kind of the new thing, where 9 months ago, the Freddie floater was the thing to do. And that's really hard to get those deals to make sense anymore. So everyone's really going largely to the bridge market. And I'm sure in 6 months from now, it'll be something a little bit different. So it's kind of always evolving.
What I find very interesting in the bridge market, again, bridge lenders, non-recourse bridge lenders are really debt funds. And debt funds have really come into the market last couple of years. They're not regulated, so to speak. They're not like Fannie Mae or Freddie Mac, or even like your local bank down the street. It is like you and I and maybe a friend of yours that have all come together and said, hey, listen, let's put some money out there. Remember how all the single family bridge funds became available? It's kind of the same thing on the commercial side, is that a lot of the debt funds are coming from current apartment ownership groups that may manage 10,000 or 20,000 or 50,000 apartment units. And they've put out these debt funds. They've gotten the money from, say, overseas groups that have pushed money into that want to get a higher rate of return, because there's no yield being paid overseas, but putting money into real estate in the United States. So if they get paid, 2 or 3%, and then they can bring that money over to you and charge you 3.25% to 4.25%, to you as non-recourse. That's how they're doing it. But what my point is, that I'm seeing a lot of these debt funds come from operators that are out there that have bought a bunch of stuff, but they know how to manage properties. So if they lend the money to you at, say, 75 or 80%, and you have a problem down the road, they'll come in and fix your problem by taking you out. So we call that in the industry loan to own. So you just have to be careful that if you think your leverage is way too high, or you setting yourself up for future failure, that the bridge lender / current operator of apartments is going to come in and take you out and take over the property and wipe out all your equity. Any comments about that, Mike?
Yeah, just like being careful on kind of some of the covenants and things like that. I mean, the space we're playing in is a little bit higher quality. We're getting, life codes have both the fixed rate bucket and the floating rate kind of bridge bucket. So that's kind of really what we're seeing on some of the stuff that we're looking at, Paul. But yeah, they be careful with the loan to own and getting over leveraged in some of these deals, because you hit any little hiccup along the way. It could be 100% wiped out, and some of those groups, like you said, maybe a touch predatory in their practices, and they can look at that as like an opportunity to buy an asset for 20 or 25 cents below market value by just like you said, loaning to owning. So yeah, be careful with what you're signing up out there, and watch out for legal bills too. That was another thing that some of these alternative lenders, will hire the most expensive firm out of Manhattan and jack your bill up as well. I know we kind of something to watch out as well when you're talking to some of these bridge debt funds.
Be careful. Michael's absolutely correct. We cannot really pinpoint at the beginning of a transaction, if you're doing a loan through a debt fund, the loan legal, there has to be an attorney that represents the lender in the transaction. And guess what? You're paying for that lender in the transaction. And you may have been told that it could be $30,000, $40,000, $50,000. If you have an attorney that represents you that's not very good, and that loan lender, the legal lender that represents the lender in the deal is going to have to do not only their work, but your attorney's work too. If they're not familiar with how to put these transactions together, that lender legal bill could be $70,000, $80,000, $90,000, $100,000. So be very careful. Make sure you're hiring a good attorney that represents you on the transactional real estate side. So just an FYI coming from somebody that doesn't want to see you lose any money. Question for Michael today. Again, we ask Michael these great questions because Michael, with owning so many properties, has great inside knowledge to help you to get you where you want to go. Hey, Paul and Michael, really love your guys, the show, and appreciate all the amazing content. Would like to submit a question to be considered for Ask Mike Monday. Well, thanks for saying the good words. Appreciate that. Hey, Mike, does applying a fixed return hurdle make a syndicator more competitive on older vintage C-class deals in tertiary markets and less competitive on newer vintage properties like A-class deals in the primary markets? And he goes on and he wants a little bit more clarification on this question. Say a syndicator wants 8% cash on cash and a 15% IRR. They take off across America in search of their desired returns, and they find a 1970s property in Kalamazoo, Michigan that meets their return hurdles. But when they underwrite the deals in Dallas on a 2010 property in a Class A area, the broker's price guidance results in only a 6% cash on cash return and a 12% IRR, so they don't buy. Question is, what say you? And I think that really is preferred returns back to the investors. That's what I think our friend JS is asking us.
Yeah, I mean, I think he's kind of encapsulating what I think a lot of the people that do what I do for a living is, I've been historically used to paying out 8 or 9%, 10% average cash on cash returns. And I'm looking at stuff in Dallas and it's really competitive because there's a ton of people coming here and a bunch of capital and they're just driving the pricing up and overall kind of returns to the way that we underwrite are, getting harder and harder to produce the same returns if impossible. So the returns are getting lower and lower. So if I have an investor pool that, when I do my structure, if I have a, preferred return hurdle of say, 8% preferred return in his question, and I can only produce 6%, I'm going to find myself like digging a 2% hole every year as a sponsor. So a lot of these people have kind of chosen to go to Kalamazoo, Michigan, as he said, or Cleveland, Ohio, or wherever, middle of nowhere, Oklahoma or Kansas, and search for better yield. But, at the same time, you're probably taking a different level of risk because there's the economy isn't nearly as large or diverse in Kalamazoo, Michigan as it is in Dallas, Texas. So, are you really going to be able to produce these returns and get the rent growth and exit? And is it liquid? Because the stuff in Dallas is extremely liquid. We could sell any of our deals, pretty quickly in this environment like this, where in Kalamazoo, Michigan, you only have a certain buyer pool out there, which is much smaller. So that's kind of the trade-offs. But yeah, I think that's what you think about when you're a sponsor or you're even a passive investor and you're investing in a deal that's got an 8% preferred return, and then a waterfall split above that. So the returns kind of are after a prioritization of the payment to the investor. That's great on paper, especially if you're an investor that you're kind of guaranteed that first, or not guaranteed, but you're prioritized to be in the first position and get 8% before the sponsor starts getting compensation. But kind of the flip side of that is if I'm a sponsor and I have an 8% preferred return, I can only produce 6%, and then the next year I produce another 6%. So I'm accruing 2% a year, so I'm kind of digging myself a hole. And then if you hit a really bad year, you can produce, can't pay out anything. You're just digging yourself a deeper and deeper hole, and then it's going to have the potential to misalign interest. where the sponsor is going to be, basically working for free. And if the hole gets, bigger and bigger and they got, 8 or 10 or 12% preferred return accrued, and then another, 8% that year, they're going to have to produce 20% before they ever see a dollar. And it might make them make a short-term decision to go ahead and just, dump the property, get out of it, because they're not going to be just working for free. They're never going to be able to get any money out of it because there's such a big hole. And that may or may not be the right thing for the investment and the investors at that moment in time. So that's kind of, I think, some of the things that I'm a little concerned about when you're doing that. And I've seen some other sponsors get a little real cute where they start getting 4 levels of returns, where they got not only class A, B, C, D shares, where sometimes Paul, like they get the class A shares where these investors get like a fixed return of say like 10%, and there's no upside, and then they're prioritized. And then the next layer of people will get like an 8% preferred, but then they graduate in the waterfall. They get participate in some of the profits, and it's just really I'm not saying it's necessarily right or wrong. It just kind of has the potential to disalign interest in an environment where you get a little behind on your preferred return, and who really is going to, actually see the money, and the sponsor going to really be making the best decisions in an environment like that. So those are some things I think of. And then to his question about going to like a secondary or tertiary market versus the primary market, I mean, the biggest risks really are you're chasing out there. You're chasing a market that doesn't have very much supply. It's not nearly as liquid. You have lower incomes typically in those areas, maybe a little less resilient economy because it's not as diverse. And then your employees and your vendors, all that's hard because you just don't have near the level of service providers in those markets that you do in a market like, say, Dallas-Fort Worth or Phoenix or Atlanta, where you have millions of people living there. So there's just some certain operating risk and liquidity risk in those markets that I think you need to kind of take advantage of. Or think about when you think about going to some of those markets, because right now the environment's great and people are searching for yield and buying everything, but this market's not going to last forever, and it'll be different in the future, and those are the markets that'll be out of favor much more than a major market like Atlanta or Phoenix or Charlotte, North Carolina, or someplace like that.
So you've done this for a while. Did you start off paying 8, 9, 10% preferred returns? And then what would your answer be to our guy who asked the question today? What should they be doing?
Yeah, I mean, we've wish it was better thought out than it was, but we just kind of always started out with a pretty flat return. So just we don't pay a preferred return, it's just an 80-20 split, and that's kind of what we've always done. Never paid the preferred return. It's kind of always worked for us. It seems, some of these other sponsors, I probably would have made more money if I had a preferred return with a graduated waterfall, because especially on the first deals we did, we absolutely crushed it in a short period of time. But by having like a graduated waterfall over a preferred return structure, a lot of the sponsors' compensation is IRR driven. So the higher the IRR, the more the sponsor is going to make. And that may or may not be the right thing for the investor at the end of the day, because the sponsor is trying to flip in and out, because if they can shorten the timeline, the IRR goes up and they get more of the pie. But the pie might be smaller for the investor versus they just waited another couple of years. The pie get much bigger if they let whatever the market mature, or that new development down the street kind of lease up, and then their property's worth more. So it just it just has a potential misaligning interest, and that's, I think, some of the biggest risk. And we've never done it, Paul, and I don't think we will have to do it, hopefully. And it's kind of just worked well for us. And not saying it's right or wrong, it's just kind of something to think about when you're putting your money in one of these deals.
Well, I mean, some great advice. I certainly do agree with that one, because if you're digging a hole that you cannot honor your contractual agreements that you're going to pay 8% and you're able only to pay 6%, and that hole keeps getting dug deeper and deeper and deeper, someone's going to take a gun and shoot you and bury you in that hole in the backyard at some period of time. That could be your investors doing it. So, I mean, sometimes preferred rates of return you would think would be a good way of attracting capital. But in the markets today, especially if you go with higher quality stuff, you're not going to be able to do it because those returns are not there. So, I mean, I guess you got to talk to investors and get them a more realistic approach to what they should expect for rates of return on their $100,000 or their $50,000 investment.
And that's what we've been trying to do, Paul, is just kind of reset expectations, because it's just not what it was 8 years ago. You can't get the same rate of return today that you could 8 years ago, because the world's found out about the multifamily space, and people are paying more and more for the same income stream.
I thought it was a little bit telling. We got a flyer that came through the office. Again, we're in Dallas, but we saw something in Inglewood, California, just a class, maybe A- or B+ property that just traded in a suburb of Denver, Inglewood, that traded at $405,000 a unit. Just kind of a nice apartment building, but nothing absolutely spectacular. And so, yeah, prices have certainly gone up, and I don't know if it's coming our way, but I would certainly think it may be coming our way. Just like we were talking about single family, it's becoming more and more challenging to find homes. So it's much more difficult, and you may have to pay more for these properties than you were thinking about, and cap rates may have to continue to compress even farther down. You did, as a bonus piece to the Ask Mike Mondays, you did an interview with Danny Baker with Cbre. Danny's one of the top producers for Cbre here in Dallas. Michael had him on the Michael Becker Show, which again is great if you have a chance to watch that. Michael interviews some of the top, whether it's brokers or vendors or some management companies, some of the top thinkers in the multifamily space. And Danny was on a recent show that Michael had. And what's some of the takeaways that you got from Danny that people would find interesting?
Yeah, I mean, they sell as much or more than anybody in Dallas-Fort Worth, and they're one of the top Cbre shops in the entire country. So they're, certainly thought leader, smart guy, and he was kind of interesting to hear him talk about. It was recorded maybe a month or maybe a little bit better ago as we released this episode here, but how all the properties he sold this year, not a single one of them had an agency loan, which was kind of what I was just referring to. You and I just were talking about that. The market kind of ebbs and flows, and what was the hot product was the Freddie floater, and the second half of 2020, it doesn't work today. They're just purposely kind of slowed it up, and just the way they size their deals with the tick up in interest rates with the COVID reserves, they still put on it, even though that's not really collections aren't really an issue. They're just purposely trying not to do business, is my impression. So the market's kind of backfilling that need with the bridge products, with the life cos and the debt funds, as we're talking about, are just getting a little bit more competitive on structure and pricing and things like that. So the market, that's where it's all going, and that's kind of what's ruling the day today. So that was one takeaway. And just about he focuses on North Texas, Dallas-Fort Worth, and just we've been the market leader for basically the last decade, maybe 1 or 2 years where New York had more supply, but one of the market leaders in the entire country in new supply. And how they're seeing big drop off in permitting in 2020. So that'll lead to 2 years or so down the road having less deliveries than what we historically have had, and how the kind of house view of market rent growth is pretty high in Dallas-Fort Worth, and he thinks it's going to go potentially even higher when the supply shortage comes 2 years or so down the road. So those are kind of two of the top takeaways I recall from the episode, and he's a super smart guy, so I always enjoy talking with him.
Yeah, Danny's good. I mean, I think one of the things I took away from that when we were talking about permits, and again, permits to build brand new multifamily, and Dallas-Fort Worth does it probably better than any place in the country. Dallas, as an example, I think they're going to build and complete 25,000 units this year. Next year, 20,000 doors. But it's a little blurry what it's going to be for the following year, just because the price of lumber and all the things that go into building an apartment building have gone sky high. I don't know if some people know this and some people don't know this, but in Dallas, you could buy just a 2x4 for $1.90. Now that same 2x4 is $7 for a 2x4. And so you start multiplying that times X, times X, times X. It's going to cost a lot of money to build these apartment buildings. And so that's going to be one of the impacts. It's just not the market for compression of cap rates, because everybody's looking to get into the apartment business, but it's really the cost of building these properties. So that's why I brought up that $405,000 unit up in Colorado, just because I thought that could be the future of what it's going to cost to I don't know, build these properties, but it's going to have a large component to what the value is of these properties, the physical characteristics of building materials.
Yeah, I think it's something like 19% of a typical multifamily project is the cost is lumber. So like, you triple the cost of lumber, it's 18-20% of the total cost. I mean, that's going to have a material impact. It's not just that, it's land, it's labor, it's appliances are hard to get. Everything's that ship stuck in the Suez Canal for a week certainly didn't help the situation. So an interest rates going up. I mean, I think we're in an inflationary environment, and so those of us that own a bunch of real things that are, got our packaged commodities per se. You got your apartments, a bunch of packaged commodities. You got your concrete, your lumber, your sheetrock, your paint, appliances, et cetera, already kind of put together. When the replacement cost starts going up and up and up, it just should kind of drag the cost of our real estate up. And I think those of us that own will be, get fabulously wealthy along the way, especially when they start doing yield curve control and stopping the long end of the interest rates running, and which is going to cause the pricing of this housing to keep going up and up and up. So while I was complaining a little bit earlier about how it's kind of hard to buy deals, I mean, I think these prices that we're seeing today are probably going to look awful cheap in 2-3 years down the road.
Tell me a little bit about what you do over at SPI. A lot of people don't understand a little bit about what operations are. How do you guys find properties? What does SPI do and what do you do?
Yeah, so the main function of our company, as I mentioned, is to buy high quality, what we think are high quality opportunities, put them together to buy these apartments, and we go out and put our deals out to investors and raise capital through kind of syndication style. That's the primary focus of our business, and we kind of have a little side business where we're help high net worth guys that have typically 1031s of size, 10 plus million in equity, come take their 1031 from out of the area and bring it to Texas, and we'll go home and help them get home on their 1031. And that was the deal in Austin. I just mentioned we got the contract. That's what we're doing right there. Have a really large 1031 and going to place it in a big, pretty deal down in Austin. So it's exciting. And that's kind of what we do. If people want to find out more information about that and reach out to us, the best way is simply go to our website, which is www.spiadvisory.com. That's SPI like spy advisor.com. There's a contact us form. Fill that out. We're always happy to send out information about potentially working with us.
Go back again on this advisory business, because I think this is fascinating stuff that you guys do. I mean, when somebody sells a piece of real estate and they want to bring it from Idaho or California to Texas, because remember, Texas being a landlord-friendly state, and some of these states not so landlord-friendly, and they've capitulated and said, I'm done having a tenant live in our property for a year or two for free before I can evict them. And again, in Texas, in normal times, if you don't pay, you don't stay. What is the typical slug of equity that you guys are going to require? And is it a joint venture with you guys? How do you guys work that typically?
Yeah, we've done a couple different ways, but we're our minimum is probably around 10 million anymore, Paul, from equity into these deals. It's just the price is going up that we don't want anything too much smaller than that. It won't afford the type of property that we want to run and manage day to day. So kind of unfortunately, with the prices going up, the equity has to go up as well. And so we've done either for a fee where we just got to help you find it and get the deal, and then get you a loan placed and get yourself with a management company, kind of walk away. But typically we joint venture with our partners, and we put some money in, form a TIC and tenant common, and get home on 1031. And that's kind of what we were able to do with the property I mentioned. And really it's just really leveraging track record, relationships, experience to get into two of the hottest markets in the entire country, really, Dallas and Austin. I mean, it's been try to go break into this market. I know a lot of people are trying to right now. I mean, it's freaking hard. I mean, we're able to deliver a deal in probably the hottest market, Austin, off market, direct from, I had a broker involved, but we're one of just a handful of people that got shown this opportunity, and we're able to kind of put together, get the right loan on it, leverage our, all the years and years of relationships to get home on a deal in a very, competitive environment, for sure, to say the least.
You say it's an unfair business, and I definitely can see that. But it also it can be a very fair business if you work with people that are skilled like SPI that already have the relationships in place for a long period of time. So I'm looking forward to listening to Danny Baker at CBRE, and I think you'll enjoy it too. So without any further ado, let's listen to Michael Becker and Danny Baker with CBRE.
Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today, I'm happy to have my longtime friend on, Danny Baker from Cbre. Danny, how are you doing?
Hey, I'm doing well, Michael. Thanks for having me on.
So Danny is the Executive Vice President for Cbre, based here in Dallas, Texas. Sells as much, him and his team sell as much or more than pretty much anyone in town. I mean, you guys done quite a bit. So Danny, maybe give everyone a little brief background on yourself. How did you get here? If you can't tell from his accent, you're not originally from here, right?
That's right. I grew up in Milwaukee, Wisconsin. Moved here right after college about 11 years ago. I've been with CB for all of that time, since 2010. So long-term CB employee. I spent 1 year in the research and consulting group and then been on the transaction side for decades. So seen a lot of things, worked on a lot of interesting things, and it's been a lot of fun.
So investment sales pays a little better than research?
It tends to, yeah, if you're good at it.
Yeah, it either pays more or less depending on how much you sell, I guess. So for a little bit of perspective, maybe kind of talk through the last couple years of sales volume for your team. Well, one, who's all on your team? Like how many team members you guys have? And then what's kind of last couple years worth of sales volume so the viewers can get a little perspective.
Sure, absolutely. So I co-lead the multifamily investment sales platform here in Dallas with my partner, Jeremy Faltis. We have Kevin O'Boyle, Chandler Sims, Anita Stewart, Chris DA, and William Hubbard. So there's 7 brokers total. Each broker has a little bit different niche or skill set. But in general, we can cover the entire market from 60s and 70s vintage, older product to brand new construction, high-rise product. So we're fairly uniquely positioned in the market where we have a skill set and capability to execute for clients from individuals, syndicators, closed-end funds, and large institutions.
And what kind of sales volume have you done the last couple of years, and what kind of basic percentage or rough percentage of the overall investment sales markets do you think that is in multifamily for Dallas-Fort Worth?
Sure. Last year's a little bit of a peculiar year, but according to Real Estate Alert, we're the #1 market share here in DFW, approximately $1.8 billion in total sales volume, which was down slightly from 2019 and 2018. 2018 was about 2.5 to 2.7 billion, and 2019 was in that same range. So down, but not substantially so.
We'll sell, what, 10 to 12 billion of multifamily transactions a year in Dallas-Fort Worth in a normalized year, something like that?
Actually, last year we did. So last year, the total market was approximately $10.3 billion. Couple of things to note there. There were a few larger transactions that made that number look bigger than it actually was, but the fact remains that Dallas-Fort Worth is the most liquid commercial real estate market on the multifamily side. It was in 2020.
Well, you say that, but every year seems to be, there's always that one little large portfolio that always skews a number, and every year there seems to be that, the next one that comes up and sells. But maybe that's a good way to talk. So you've been selling apartments about a decade now. What's kind of like really kind of the pre-COVID evolution to kind of where we are today? We're kind of towards the latter part of Q1 2021 as we record this. What's kind of different from say 2-3 years ago? How's the market functioning different today from then?
Well, one thing has stayed the same, except for the first 6 months of last year, or really the second quarter of last year. One common theme in this market is an extremely high level of liquidity and investor demand. We live in the best market in the Sun Belt, in my opinion.
Yeah.
Others would argue Phoenix. But if you look at the 3 top markets in the Sun Belt region of the United States, it really is Atlanta, Dallas, and Phoenix.
Yep.
We are comprised of the things that really drive apartments, which would be net immigration and job growth.
Yep.
Not to make it too simplistic, but that's what it is. I mean, and you look at the demand side of the equation, and that's where you want to be investing in apartments, and it's population growth and job growth.
Okay.
So we have both of those things. So to compare where we are right now to 3 years ago, I would actually argue that we're in a supercharged environment right now. COVID really accelerated some demographic trends that were occurring already 3-4 years ago that fueled our cycle, the latter part of last cycle. It accelerated dedensification of urban areas. So right now we're experiencing significant net immigration from both coasts, really the tri-state area in California, as well as Chicago. So I believe that what we experienced last year is an accelerator effect that really is going to push DFW into a position of being a market leader the next 10 years.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
That's the demand drivers, but we have always leading the nation, or neck and neck with New York City leading the nation, and new deliveries as well. What are you seeing as far as like equilibrium? Have we been able to kind of keep up with the deliveries with absorption for the last real decade, I guess?
No. But we're not far off.
Yeah,
I think is the point. Last year we led in apartment absorption across the entire. Leasing was down, but we led the country in apartment absorption because of the things that we just discussed. But we are in a market where we have experienced higher levels of supply. But let's be honest, the reason that developers are building assets here is because people are moving here.
Sure.
So as a total number of units delivered in 2020, we did not meet that demand. I do believe this year will be pretty close. But one thing that's really interesting on the supply pipeline is we permitted 44% less units last year than 2019.
Okay.
So given that fact pattern, I believe that there will be a gap in the supply pipeline in the next couple of years, and very quickly, any of that excess supply that's in the system will be absorbed and things will change. And not that we're in a bad state or wildly off equilibrium, we just tend to build a little bit more than we need, but it does get absorbed. It just doesn't happen exactly in that calendar year.
So historically, the last 4 or 5 years, we've been somewhere in the 40 to 50,000 units under construction at any one given time, delivering somewhere around half of that at any one year, right? So we're having 20 to 25,000 units, give or take, deliver every year, absorbing the vast majority of that. So we're generally in equilibrium. And what you just said is we had about half off the number of permits in 2020 versus 2019. I think the number you told me the other day before we started recording was 27,000 units were permitted in 2019 and about 15,000 were permitted in 2020. Is that correct?
That's correct. And just one qualifier for that, the way that the Dallas Federal Reserve Bank tracks that data is by number of units in a structure. So they do 1 unit, 2 unit, 3 and 4 is lumped into one category, and then structures with 5 units or more. Right. So if you look at the larger apartment buildings, 100 plus units, not all units that have 5 units or more are 100 plus, obviously.
Sure.
So 15,000 units were permitted last year, down from 27,000, so about a 44% contraction in permitting activity last year. So yes, that is a substantial amount of contraction in permitting activity, and I believe that is going to lead to an accelerator effect in our market.
And so that would be units that would have delivered in, say, late 22 or somewhere in 2023, generally, because it takes couple years from permitting to actually leasing units. I think you couple that with the headlines that you read is lumber's up, double to triple, labor, land, all the input costs of this development is going up and up and up. So we're seeing ever escalating costs to deliver some of these product as well. So we have less product and escalating costs. So you would think that the new delivery pricing for these developers to exit and make a profit have to be ever escalating. I don't know if you have any comments around that as well.
Sure. We recently capitalized an asset not too far from here, actually, and the cost for that building was just over $273 a foot. So, so yes, I mean, we are feeling the pressure of escalating hard costs and soft costs. And frankly, we've been in a development boom on the commercial side, not just multi, but commercial in general for the last decade. So availability of sites is significantly less than what it was 10 years ago. So if you ask some of the developers, where they're building right now, a lot of the groups that are building garden style product are having to go much further out than they were 10 years ago. So I believe the barriers to building are definitely higher than they were 10 years ago, coupled with the permitting activity. And I think there's going to be a pullback in the supply pipeline. And frankly, there probably shouldn't be with the amount of people moving here. We have 7.3 million people that live in this metroplex. By 2030, we're forecasted to have over 9 million people living here. We probably should be building units for these people to live in. And you look at where we're at on the single family side of things, 1.4 months of supply.
Yeah, wow.
Equilibrium, 5.5, something like that.
Yeah.
1.4 months of supply. You go to an open house, there's 60 plus people milling around. I mean, we are potentially in the middle of a housing shortage right now if you take the housing stock as a whole, not just the apartment side of the equation.
And so so obviously rent's going to project to go up. Will you have any sort of sense on, I know Cbre has a large research department. You were there for a cup of coffee. What is that looking like? What is kind of the house view or your personal view kind of going forward? What are we seeing for rental rate growth?
So the data that Cbre Econometric Advisors has broadcast for the calendar year 2020 is just over 3% market-wide rent growth in Dallas-Fort Worth this year. The accelerator there is 2022, 6.3% market rent growth.
Oh, wow.
If with an inflation target of 2%, I mean, that's very serious rent growth in 2022. And with your timing that we were talking about before, a potential pullback in the new deliveries in that late 2022, early 2023 timeframe, I mean, we could be looking at 5 years of above inflationary rent growth through the recovery phase of this cycle into the growth phase.
So greater than 6% potentially kind of going forward would not surprise you?
It wouldn't surprise me. Maybe it doesn't sustain 6% through 2024, 2025, but I would believe 3 to 5% rent growth during that period of time. That's my personal view, not the view of my firm.
So with the population coming here, pullback in supply, projected rental rate growth, the capital has to just be flowing in, right? So what's kind of the market participants from a capital perspective right now, and how is that different than a couple 3 years ago?
The last 10 years, really since 2010 to 2019, our market changed in complexion of capital. Pre-2010, our market was largely a private market, private capital, private investors, syndicators. 2010 to 2019, because of the growth characteristics of our market, institutional capital started showing up materially more on bid sheets in our market. Now, I believe that is a trend that's going to continue. I believe that trend continued to solidify itself with the demographic changes that we saw last year that accelerated. So I believe that the complexion of our market is going to be much more institutional on a go-forward basis. For instance, some of the publicly traded REITs have gotten board approval to deploy capital in this market. Now, these are investors that have historically played in gateway cities, coastal markets. So the fact that a couple of those investors are now looking to deploy capital in a non-coastal Sunbelt market, I think that's just one anecdote where there are many more out there that would solidify that point. So as far as where I feel we are right now on the capital market side, as far as investor sentiment, investor interest, I'm on the phone all day. Every broker's on the phone all day. we are fielding a lot of calls and having a lot of discussions with existing clients of ours, clients of the firm from other markets, and investors that are coming from other product types. So the inflow of capital into our market, right? Really the inflow of capital in the apartment sector and the inflow of capital into the apartment sector focused on Sunbelt cities right now is palpable. We have discussions with investors from California, from the West Coast, from the East Coast, family offices, 1031 investors that are looking to redeploy proceeds into DFW, institutional investors that need more Sunbelt exposure, that are reallocating within their portfolio away from office and retail and reallocating that capital into multifamily and industrial, which are the two asset classes that really we're seeing the target of the reallocation game right now, as well as a lot of the larger closed-end funds and operators that have never been in this market before that are now here actively acquiring assets. So I believe from a demand perspective in the capital markets that we've never been at a point in time where the demand for apartments in this market has been this high. We've been in a very good position for 10 years. Don't get me wrong. We've been in this was a very robust transactional cycle for us, 2010 to 2019, with similar, if not heightened, growth characteristics on the demand side of the equation from a population and job growth perspective, coupled with heightened capital demand for apartments in this market. I believe that this market is extremely healthy right now.
So we got unbelievable demand. We're having projected rental rate growth that should accelerate. We're having costs accelerate to build this stuff. We're having hard times getting sites. This money's coming in, and that institutional money now they're allocating to the Florida, Arizona, Texas, Georgia, where they maybe wouldn't have been so heavy. Maybe it would have been more New York, DC, California focused. Is that money also coming into suburban, or are they focused on urban core? And is that new money, kind of the institutional money, coming into only brand new development, or are they also looking into the workforce housing?
Yes.
Everything?
That's a great question. And we could sit here and talk for 3 hours about that. So the suburbs have the hot hand right now from a rent growth perspective. Our infill market has been in somewhat of an oversupply state for a couple of years. I think that's going to change. I think that's going to change probably sooner rather than later. But
that supply's shifted to the suburbs right now, right? The new development?
So a lot of the new development, yes. There's more supply coming in the suburbs. There's definitely still some supply in the infill market that we're going to have to work through. But COVID shifted renter preferences to the suburbs. So we're seeing outperformance in rent growth in the suburbs right now. I believe that the infill market's going to come back from a fundamentals perspective pretty quickly, and I think that light can turn on very rapidly. So we're seeing the capital come to this market, and there's not one specific theme. The theme is we want apartment exposure in high growth markets like DFW that has a highly diversified economic base. So we are seeing a lot of the private investors looking for exposure more in the suburban markets, and a lot of that capital wants some sort of value add component to the property where they can manufacture yield and be in charge of what that profile looks like. The institutional capital historically has looked at development and infill markets. We are seeing some shift in that strategy to more. We're even seeing some institutional investors buy workforce housing assets and shifting strategies and definitely deploying capital into value add. And there are those groups that are still looking for infill. So at this point in time, there isn't one specific theme there. I guess the theme is that investors want apartment exposure here, and whether it's an infill asset or a suburban asset, there are going to be investors and buyers for that product.
So with this institutional money coming in, the people that are already here are probably doubling down. They're not going anywhere, right? Guys like me are still buying and staying here. And the suburban, irrespective of grade, is extremely hot. What are you? would it make sense to you, in your opinion, you know, like what's kind of the best opportunity you see right now, in Danny Baker's personal opinion? Because we've been historically buying a lot of suburban stuff, so I'll kind of just talk about what we've been focused on. You know, you've seen a lot of what we've done. Started in the workforce housing, traded up into kind of better quality suburban, straight from the developer, Class A stuff to kind of A-. And now I'm looking at all the stuff that you could buy kind of in the urban core or next to the urban core, and uptown Oaklawn, East Dallas, you know, some markets like that are in town Fort Worth. And you could buy it, you know, at or below current replacement cost. And there's the supply that used to be extremely robust, and a lot of it coming is now tapered off to next to nothing. And so it seems like that might be the place to kind of zag, as everyone's going to the suburban markets. Do you have any thoughts on that kind of basic thesis or strategy?
I would say, my personal opinion, if it's an apartment building where people live in it and pay rent, you can make an investment case for buying that asset.
Okay.
Apartments have, for a very long time, and I believe is one of the best hedges against inflation. Yeah. So either we're going to be in a low rate environment for a long time with not a lot of inflation, with the target at 2% on the 10-year.
Yeah.
10-year inflation target, or we're going to experience inflation, and apartments are going to be an exceptional place to be invested. So I like, personally right now, I think that the suburbs are extremely competitive.
Yeah.
They're competitive for a reason. So I think there's definitely merit to buying assets in the suburbs, because there's rent growth there and renter preferences are there.
Okay.
It's difficult to buy in the suburbs right now for high quality assets because of how competitive it is.
Yeah.
I like newer constructed assets. Right this particular moment, there is a little bit of a gap in the capital markets for that product because of the supply issues that we have had over the last couple of years. So to your point, if you can find an asset that's a little bit newer, and you can buy it below replacement cost, then there's definitely merit to that too.
Yeah.
Our infill market right now, I don't think there's going to be a lot of trades in that market until there's some semblance of rent recovery, which will likely happen a little bit later this year.
Yeah.
But I like the infill market. I think Uptown is very cool. I think Deep Ellum is very cool. I think Bishop Arts is very cool. So I think as Dallas develops as a city, and more people go back to work, I think the infill market is going to turn around extremely quickly. So to answer your question, not intentionally being invasive, I just think apartments are a great place to be right now, and you can make a case for really any asset class and location here.
So speaking of that, I think it's really helpful for people to kind of understand like the current state of the market. You recently had a couple two property portfolio, I think it was, that went off and was pretty aggressive in the bidding process and the interest to it. Do you have maybe a deal story or two you kind of share about kind of recent trades or recent deals that you marketed, and kind of that illustrates the level of demand that's going on right now?
That would be a good one.
Yeah.
It was a two-property portfolio, workforce housing, 8-foot ceiling product, in pretty good workforce locations, with, call it 80% of the units left to renovate. So there was a lot of value add upside to both of the properties. We ended up having 50 tours across both properties, 35 bids in the first round. We took a handful of investors officially into best and final. Some of the groups that didn't make the cut wanted to participate in the next round. We made, I think it was 7 calls or 6 buyer interview calls, and then we selected somebody. But that bid sheet is a perfect example of the profile of capital that's looking to deploy money in this market.
Yeah.
We had institutional money, we had private syndicators, we had family offices, we had 1031, and we had a couple of closed-end funds that were looking to acquire those assets. Yeah. So it was really every type of investor showed up on that bid sheet, and it was very aggressively bid because it had some of the markings that a lot of these investors look for. 8-foot ceiling workforce housing, which is a big mandate for a lot of groups.
Okay.
A lot of upside potential in classic units. Very good workforce locations near demand drivers, medical and industrial logistics. And they priced below replacement cost.
Yep.
So if you have those things in scale, that was a $60 to $70 million transaction between the two properties.
Yep.
You're really hitting the meatiest part of the bell curve as far as capital demand goes.
Okay. And so I know I lost my train of thought earlier, but what I was going was we got replacement costs escalating, supplies coming down, interest rates are historically low. Demand is crazy. We project higher rental rate growth in the future. Like, how the hell are you going to compete in these deals, today, let alone 2-3 years from now? It seems like get your knife out, right? It's a knife fight, and it's going to be hard. And if I want to buy deals in 2021 and I want to buy deals in 2023, 2024, where do you need to position yourself if you're kind of coming to this market? You're not in this market. You want to come to this market and get in here, or maybe it's Phoenix or Atlanta or wherever. It's probably relatively similar across. Any advice or any sort of tips if you're trying to break into this market?
Yeah, that's a question that I get often.
Yeah.
We have some investors that want to be here that show up and they submit a bid in the first round without really digging in, thinking that they're going to be able to participate in a competitive process and get a favorable look or treatment. We want to treat everybody fairly, but our responsibility as brokers is to represent our client and curate a bid sheet and make the market with the most highly qualified and aggressive capital in the market. So if you're new to this market, it's good to make contact with and build relationships with market participants, whether that be a sponsor if you have equity you want to deploy and use that equity in a joint venture type structure, or if you want to buy direct and you're an operator. It's good to make contact with market participants so they know who you are when you go and tour a property. That being said, but one thing to add to that would be when you're underwriting a property and touring a property and bidding on a property, ultimately, you want to be able to convince the broker that's representing the seller in the transaction that you are qualified to buy the property, you have the equity and the debt lined up to buy the property, you've done a thorough due diligence, especially for new entrants to this market, understanding property taxes, understanding insurance, and things that are things that don't necessarily translate exactly from market to market. Being able to elucidate that to capital or owners rather would be highly important. I would say. So being dialed in on your capital stack, being dialed in on how you're going to get the property closed, and giving the broker comfort so he can relay that to the seller that, yes, this investor has spent the time and the diligence to get to this point in the process and they're qualified to buy the building. Yeah.
And are you still got to come in town because a lot of these institutional groups wouldn't even get on an airplane up until recently. Maybe some of them still aren't. I don't know. And it just seems like it's going to be really challenging. So you need to start spending time in the marketplace too, because I mean, they got to go against a guy like me that's got a decade or better going to the bar and shooting stuff and golfing and all that kind of activities with all the market participants, like you mentioned. And it's a completely unfair business. And you got to fight guys like me and Charlie and David down the hall over there. And I mean, it's going to be a little bit of an uphill battle. So I think it's really about getting into the market, like you said, spending time showing your face and getting people to know, like, and trust you on top of all those fundamental things that you mentioned, because at the end of the day, it's really kind of a lot of this stuff is like a soft skill business, and it's on the margins, those little soft skills kind of make or break a lot of these deals, for sure. So with all that said, is there any deals that you guys have coming up? What's kind of like, as we're kind of exiting the first quarter going forward, any deals that you kind of have coming up that maybe you could share with the viewers and kind of get a flavor of what's happening right now and not what happened a month or two ago?
Sure. So last year was an extremely high level of transaction activity. A lot of that was weighted in the back half of the year.
Sure.
That's a lot of trades in 6 months, $10.3 billion. Now, not all of that happened in the last 6 months, but a lot of it did. Going into 2021, the environment dried up a little bit from an opportunity perspective. That's not just here. That's in Houston. That's in Austin. That's really across the entire Sun Belt.
Is that because we didn't have an NMHC this year, so there was no natural driver to do that? Plus, kind of coupled with a lot of these trades that would have been spread out through the year, all were concentrated, like you said, the fourth quarter largely.
That's part of it.
Yeah,
that's definitely part of it. Having NMHC in a conference where everybody gets together and discusses their strategic plans for this year, and having available opportunities to take to that conference that's part of it. I think the other part of it is we never really had the large delinquency issues that other parts of the United States had. So owners here are still collecting the vast majority of the rent. But there are some owners out there that are having some delinquent buildup behind the scenes, and how to deal with that in an environment where there's an eviction moratorium. Yeah. So not that it's a major problem, but just understanding how capital's going to underwrite through that, and how the lender's going to underwrite through that has been an important discovery phase of the first part of this year. And I think that we're going to start seeing significant transaction activity coming in the next 30 to 45 days. It's already starting to happen. There are properties starting to hit the market. But I do believe cores 2 through 4 are going to be extremely robust. And I think we'll probably be back generally to where we were last year from an activity perspective, maybe even higher, which is a fairly profound statement, frankly, with the amount of activity that we had last year. So what's happening right now? So as a leading indicator, the tip of the spear, so to speak, the amount of BOV activity that we have right now and some of our peers and competitors have, that's a long list.
Yeah.
So we're working long hours. We're at the point where, it's all hands on deck to manage through the BOV activity and valuation requests that we have from our clients to prepare assets for market. So I think that there's about to be a lot of properties in the market.
Where roughly are you on your number of BOVs you're working, and how does that relative to historical norms?
28.
28. What would you normally be doing at any one time?
Any one time, we're always busy.
Sure.
We have 28 right now, and I feel like a higher percentage of those are live fire drills as opposed to, hey, just what's the spot value of my asset in the market today? So we're busy. I think everybody's busy.
Is that double what a normal time period would be for you?
If you just pull a random date in a random year the last 36 months, we're probably underwriting 10 to 15 properties at any given point in time. So probably about double.
And then what you have a nicer new kind of A asset and maybe a little bit more workforce asset that you're about to bring out. Maybe you can share what that looks like right now.
Sure. We have a Class A value add asset in the northern suburbs that will be fully in the market next week.
Okay.
We launched the Coming Soon earlier this week. Extremely high quality garden product. It was built by an institutional developer. It's been institutionally owned for a long time. So the property's in exceptional physical condition.
Okay.
The current owners renovated some of the units. In my opinion, the scope that they've done is really nice, but that submarket would substantiate doing hard surface counters and taking what they've done to a little bit higher level.
Okay.
And additionally, you have the classic units that have not been touched. So that's a deal that'll be coming. That'll be in the $70 to $80 million range.
Okay.
And then we have a 2-property portfolio in the market right now, one in Grand Prairie and one in Arlington that's bidding in 2 weeks from now.
Okay.
So those are 2 that I would definitely pay attention. That's about a $60 to $70 million transaction between the 2 properties. They'll sell individually or together, and both of them are free and clear with a significant amount of value add left on the rent roll.
And so what's, generally speaking, kind of our market cap rate for your generic middle of the road kind of A, B, C deal? What are kind of the market cap rates today? And what is that, 24 months ago, 12 months ago, relative? How have they moved?
Down. We've seen and experienced fairly significant cap rate compression over the course of the last 12 months. Last year, we were low to mid 4 going in cap rate. And when I talk about cap rates in this type of context, I like to use a T90 revenue, T12 expenses with the pro forma tax reassessment layered in. So a real NOI, real operating expenses.
And so that was 4.5 to 4.25, irrespective of grade in 2019?
For quality value add product, whether it's 80s or 2010, the cap rates were not exactly the same, but they were generally in that low to mid 4 range. Where we are today as a result of where the debt markets went at the end of the last year, now they've moved out a little bit, but the bridge lenders have stepped into the space in a meaningful way. So you can get very accretive debt right now. So because of the liquidity on the debt side of the equation, and because of the liquidity and capital demand on the equity side of the equation, we've seen compression. So right now, it would be difficult to buy an apartment asset in this market with the 4 handle in front of it. So we're mid to upper threes from a going in cap rate perspective. And that's not on an NOI that has significant impairment on the revenue side with delinquency or vacancy, because we haven't seen a large change in either of those line items at this point in time. So that's a real going in cap rate.
So last 12, 18 months, we've seen about 50 bips of compression. And
maybe 75.
Maybe 75. And what are most of the buyers underwriting like a year one pro forma cap? Or most of those kind of that low to mid 4 pro forma year one?
You can use that as a general approximation, but we're no longer a direct capitalization market to derive value. We're a total return market. So the year one cap rate is kind of just the implied cap rate. So we shifted from a cap rate market to an IRR market or an IRR underwriting a number of years ago. And that's where we are right now, especially with value add deals where you want to capture what the cash flow profile looks like, at stabilization in year 3 or 4. A total return is really the best metric. But yeah, I would say mid 4s on a year one cap rate for high quality 80s vintage product, and it'll go south of that for newer vintage assets. So the one component on the value add side of the fence is the cap rate going in matters significantly less than the total return and what your stabilized cap rate and yield on cost look like in year 3. So that's really the metric that we like to look at is stabilized yield on cost in year 3, and that's generally in the low to mid 5s.
So you said something as we kind of wrap up the conversation. You said something before we started recording that I thought was amazing, that you haven't sold a deal that had an agency loan on it and however many months has been now. This year. So all year you haven't sold a deal that had agency financing on it. And last year it was probably almost exclusively agency financing because there was the only market that was out there. We've seen the 10-year Treasury through first part of 2020 and then kind of stayed low throughout 2020, got to, 50, 60 basis points on the 10-year Treasury. We've moved, as we talked today, roughly 100 basis points, a full percentage point up on the 10-year Treasury. What's your personal opinion on that? If I'm coming in this deal, would I go out and take a fixed rate loan on these deals? Do you think the bridge market's where it's at right now? Obviously, the market is doing a lot of bridge, a lot of debt funds, as you mentioned that those were completely gone for the better part of 6-7 months, kind of slowly turned on last year, and it seems like those the terms and everything are materially better than what the agencies are right now, just by being a guy in the market looking at stuff. What would you recommend for your clients to do? Put a 10-year fixed rate mortgage on it, float it? What's your crystal ball say?
This similar fact pattern unfolded in 2016. And what we saw a lot of clients do at that point in time is put on long-term fixed rate debt, thinking that if we sell this in a couple of years, we'll have some IO left and the debt will be accretive to the new buyer and we'll be able to uncover a premium from a pricing perspective. I would say some lessons learned from going through that exercise 4 years ago with a lot of clients would be float your debt. Unless you're planning to hold your asset for 10 to 12 years, it would be highly recommended to match your debt with your business plan, which would be floating rate debt with prepayment flexibility. Our market is extremely transactional. And if you want to be able to take advantage of moments in time in our market from an appreciation perspective and realize gains on assets, it would be better to float your debt than fix your debt for a long-term period of time. Now, if you're a long-term holder and you want to lock in low rates, that's probably a good business plan to put in longer term fixed rate debt. But just from a flexibility perspective, if you're buying a value add deal that you intend to sell in 3 to 5 years, right now, bridge capital is an extremely accretive avenue from a debt financing perspective to explore. And having flexibility on your prepayment penalty would be something that I would highly recommend. And lastly, don't ever meet your maturity. Have an exit strategy in place going into the building. Maybe you don't know exactly what month you're going to sell it. Everybody's going to model we sell it in month 36 or 48 or whatever. But always have an exit plan in place materially prior to when your loan matures.
And so I would deduce that your view is that this run up in the 10-year Treasury is probably towards the later endings of it, and you think that we might pull back on the 10-year Treasury, or do you think we still have some room to run on the 10-year Treasury, and we're going to see north of 2% for the better part of the year?
I don't know.
Yeah.
I wish I did. Like, I wish I could sit here and say they're going to be X in 3 months. But I believe that the Fed is going to intervene and the 10-year Treasury yield is going to come down. I don't know to what level, but I believe they're going to come back down and be at a sustained level for a couple of years. One thing I will mention is the two indexes that are down, as we sit here today, LIBOR and SOFR.
Yeah.
So floating rate product is extremely attractive right now, especially with rates moving the direction that they have over the course of the last 30 days.
Yeah, no doubt. So Danny and his team at Cbre sell, as I mentioned, as much or probably more than anyone in Dallas-Fort Worth. They certainly have a pretty robust team, and they sell anywhere from your lowest workforce housing, C-class stuff, all the way to brand new Class A. Sell several portfolios with their other offices across Texas and the general Sun Belt. So, Danny, if people want to get to know you, learn a little bit more about your listings upcoming, what's the best way for people to get some information about you?
Call me or email me. So you can find me at danny.baker@cbre.com. Please call. I love to talk to investors that are either here already or investors that are looking to buy product in this market. And we pride ourselves on sourcing capital and bringing new investors to the marketplace. So please feel free to reach out. I would love to have a discussion with you should you have any questions for me or anybody on my team.
Well, Danny, definitely appreciate your time today. So for Danny Baker, I'm Michael Becker. We'll see you guys soon.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.